Stop everything you're doing. The illusion of stability is over. The ground under your financial assumptions is about to collapse. We stand at the edge of a financial fault line, one that promises seismic shifts that will rattle markets to their core. At the heart of this lies the U.S. Federal Reserve, the institution that shapes the rhythm of global economies, now a ticking time bomb. Enter Kevin Warsh. His nomination wasn't just an administrative shuffle, it was a catalyst. The markets had already tethered themselves to a narrative. The expectation of an inflation hawk ready to fortify the dollar and stabilize the economy. But like so many times before, Wall Street's echo chamber and the real forces at play are set on a collision course. Investor sentiment appeared calm, an exhale of relief buoyed by old certainties. But beneath this surface, the mathematical walls were closing in. The numbers told a different story, a hidden script of impending volatility. Investors who believed in the facade are momentarily blinded, seconds away from a cataclysmic misjudgment. Stocks fluttered momentarily. Whispers became shouts. As the echoes of Warsh's potential appointment reverberated through trading floors, a subtle tremor took hold. We faced the prelude to disruption, where decades-old reliance on institutional decisions gets questioned yet again. In this chapter, understand that Warsh's nomination isn't an isolated event. It's a domino in a much larger, unspoken game. The global economy sways as the Federal Reserve acts. It dictates the tides. But every step, every whispered hint of policy change carries with it the power of tidal waves. The Warsh effect isn't just about one man. It's about how quickly market perceptions can trigger unforeseen consequences. Stay alert. The time left is scarily limited. Panic is brewing just beneath the surface. Kevin Warsh's anticipated role as an inflation hawk appeared straightforward. A predictable tightening of policy, a safeguarding of the dollar. Wall Street's chorus eagerly nodded in agreement. But reality often defies expectation. The air was thick with assumptions, but those too often become the rope that hangs the careless investor. As Warsh's name circulated, market narrative shifted. It wasn't a graceful dance. It was a jolt. The market's collective consciousness misread signals, diluting itself into comfort, a dangerous complacency before the storm. Market reactions were swift but misguided. There was no immediate rally in strength, no instant validation of the hawk's creed. Instead, a brief flutter of optimism gave way to uncertainty. As Warsh's potential confirmation loomed, the markets hesitated, stifled by anticipation and fear. The dollar, rather than soaring, began its quiet decline. Investors rallied around old doctrines, clinging to illusions of multi-factor strength and economic control. But in truth, they ignored basic arithmetic. They misjudged, and the tremor became tangible. As speculation brewed, bond yields held their breath, waiting for clarity that never came. Stability was a mirage. Investors sought refuge in hard assets, inadvertently driving silver prices up. Each tick of the clock whispered urgency to those willing to listen. This was not a drill. The market's fabric was fraying, revealing vulnerabilities unseen by the passive observer. The Warsh effect exemplifies how fragility breeds chaos. A single nomination, interpreted through the lens of shaky optimism, can trigger a cascade, turning assumed stability into downward spirals. Here, the investor's mind was the first line of defense, but many had surrendered to blind faith. The wake-up call is harsh, but essential. The time to extricate from illusion is now. Reality harbors little compassion for the complacent. Act before the cascading echoes become deafening. In the latticework of financial machinations, every pivot is fraught with peril. Kevin Warsh's nomination, expected to be a bulwark against inflation, instead underscored systemic fragility. Wall Street, ever hopeful of a hawkish sanctuary, was blindsided. The narrative, fervently accepted, unraveled, a dangerous misreading of tea leaves. Consequences compounded swiftly. The market failed to grasp the shift in axis. A false dawn of dollar fortitude dissolved into dusk. The currency didn't surge on hawkish wings. It faltered, echoing an underlying malaise. The ripples of expectation fractured upon cold, hard reality. Investors, entrenched in dogma, watched in disbelief as the greenback's decline gathered momentum. In the shadows lurked a simple truth. Expectation is the prelude to calamity when uncoupled from reality. In an era where every percentage point commands attention, the bond markets fell into silent suspense. Yields, poised at the precipice, awaited a signal, any signal, to preempt what seemed inevitable. But the silence grew louder. The promised clarity vanished into the ether, driving capital towards tangible refugees. Silver, gleaming with new allure, became the unlikely hero in this unfolding drama, an unintended beneficiary of strategic blunders and a wary hedge against equivocation. The axiom holds true: complexities mask weakness. Warsh's enigmatic presence served as a catalyst, exposing the labyrinthine intricacies and shortcomings. These dynamics illuminated the stark divide between perceived wisdom and actionable foresight, a strategic miscalculation left unchecked. Now the contagion of uncertainty pervades, demanding vigilance. This paradox, the so-called Warsh effect, is a clarion call. Market dynamics are neither static nor forgiving. Interpretations skewed by optimism lead quietly to the guillotine of unforeseen consequence. There's no sanctuary in placeholders for reality. The sirens of stability are not to be trusted. Intricate swindles of belief now demand a rapid decoupling from misplaced faith. With markets at the mercy of whims, reaction time shrinks by the second. In this turbulent theater, the pathway is treacherous and echoes of past naivete hover ominously. The vigilant must recalibrate, analyzing anew, sidestepping the inefficacies that siphon prosperity to entropy. As the night looms, heed the warnings not just with understanding, but with preemptive action. Secure your positions against the inevitable turbulent churn. The luxury of error is spent, the hourglass drains. Kevin Warsh was once heralded as the vigilant inflation hawk, a reputation as sturdy as bedrock. Yet a critical misstep turned perception into illusion. The narrative, flawed at its core. Markets, lulled by the siren call of certainty, invested heavily in the myth. That confidence shattered under the weight of reality. Warsh's presence, expected to be the lodestar guiding monetary policy, instead became the storm that clouded vision. Hopes of stern interest rate hikes and aggressive inflation control faded. Expectations became as phantoms in fog. Markets realized too late the vast gap between legend and reality. The presumption of Warsh-wielding inflation-slaying prowess revealed itself as a mirage, investors trapped within their own assumptions. Warsh's appointment failed to signal a tightening of chains on rampant inflation. Instead, it unveiled a paradox. His enigmatic policy seemed more illusionist in practice than hawk. Key tenets of monetarist dogma, interest rate ascendancy and currency strength, wavered visibly. Minute by minute, the certainty of decisive rate action dissipated. The question should never have been, will he act? Rather, is his philosophy still grounded in the arena of action? A bifurcation emerged. Market participants recognized Warsh's stance not as a beacon of hawkish rigor, but as a vice of indecision gripping the Fed. Interest rate strategies inadvertently softened. Consequences cascaded beyond the immediate. Inflationary pressures remained unchecked amidst this indecisiveness. The market misread an omen. Inflation persisted, rates steadied, and the dollar bowed. The dollar's once stable edifice trembled, unveiling vulnerabilities in assumption. An enigmatic persona doesn't equate with proactive deterrence. Warsh, venerated as a sentinel against economic woe, accentuated systemic fissures, an artifact of nuance. His presence cultivated neither the severity nor security anticipated. The only true hawk lies in proactive response, not contemplative reticence. Market equilibrium falters when reality reveals its teeth. The fall from rhetoric to realization is rapid. Warsh's legacy becomes not the subjugation of inflation, but the perpetuation of monetary uncertainty. The myth of the inflation slayer stands debunked. Preparedness, not presumption, becomes the true hallmark of foresight. Stay sharp and brace for the monetary convulsions to follow. The prelude has passed. Expect no rebirth of the hawk. Winter is here. An interconnection unfolds. The dance of currency and commodity. As the dollar weakens, commodities rise. It's the law of inverse balance. Denominating commodities in dollars creates a fixed tether. When one shifts, the other counters. A weakened dollar is an invitation, a clarion call for commodities like silver to ascend. The dollar index, DXY, becomes a metric of miscalculation. Investors previously complacent now confront a harsh recalibration. Every point lost in the DXY translates into a surge, not in value held, but in value perceived elsewhere. Silver gains its luster. Silver, a beneficiary of this calculated currency erosion. A retreating dollar exalts silver as a safeguard. True value emerges when traditional metrics falter. The correlation is stark. As one withers, another thrives. Yet, this is not mere happenstance. It's the natural order where currency depreciation uncaps potential in tangible value stores. Silver, historically shackled to a dominant dollar, uncoils when given freedom through currency softness. This isn't a new narrative. Its archetypal economic mechanics played anew. Acknowledging this currency and commodity interplay is critical. Ignoring it risks slipping into obsolescence, tethering portfolios to fading assurances. Complacency's penalty is severe. Here's your insight. The inverse relationship is immutable. Recognize the parameters where currency depreciation breeds opportunity in hard assets. As the dollar teeters, seek refuge in commodities that history has proven resilient even amid currency turbulence. Heed the centuries-old truth that when the monetary tide recedes, tangible assets remain. Protect yourself in this realization, and never underestimate the market's ability to devour those who misjudge it. Emotion is the silent catalyst in market dynamics. Investors kid themselves if they believe logic alone drives the tides. Warsh's nomination revealed a deep psychological undercurrent that rippled through trading floors and investor portfolios. Those watching the market saw more than just numbers. They witnessed the raw nerve of sentiment exposed, the primal pulse of human reaction. Informed investors, possessing the rare mix of insight and intuition, relished the moment. They were not blindsided by the superficial facade of stability. For them, the market's perceived instability was a carefully orchestrated symphony, each note expected, each crescendo predicted. This mastery turned seemingly adverse conditions into fields of opportunity. Where others saw chaos, they found clairvoyance. Conversely, the majority, unprepared and unsure, succumbed to panic. They sell at the whiff of volatility, caught in a frenetic dance dictated not by intellect but by fear. Their reaction, impulsive and chaotic, amplifies the very volatility they dread. Panic spreads like wildfire, consuming rationale, turning the markets into a battlefield of nerves. Here's the insight. Markets are not just defined by assets and equities, but by the psychology of its participants. Fear and greed, twin forces, govern the rhythm. Those who master emotional detachment and strategic foresight can rise above the fray. They pivot with precision where others are rigid, calculating outcomes rather than presuming stability. Comprehend the emotional blueprint. Acknowledge that the market moves not only on facts, but also on the tremors of collective psyche. Preparing emotionally is as critical as preparing analytically. Steel your nerve, focus on strategy, and you will not only survive, but thrive amid the storms of sentiment. Welcome to the volatile dance of the silver markets, where emotion and strategy clash in a relentless tango. The perfect storm brewed, fueled by the misaligned perceptions of a hawk who was never the beast they anticipated. Silver soared in the aftermath, not as consequence, but as a deliberate act of misjudged narratives. Rewind to the moment when Kevin Warsh's nomination unset the orchestrated stability, a reckless wager by Wall Street. Silver, traditionally overshadowed by its golden sibling, suddenly basked in the spotlight. It was not just a simple rally, it was a violent upheaval, a meteoric surge that signaled more than opportunistic trades. The market sent a message. It was time to confront its undervalued potential, yet do not be fooled by this transient shimmer. The surge was not just a numerical ascent, it was a cautionary tale coded into every transaction, carving its trajectory through the market consciousness. This was the inflection point, a culmination of spectator misjudgments, informed insight, and raw emotion. Commodities like silver have always defied simplistic economic principles, seated at the crossroads of market interpretation and reactive sentiment. Investors' fixation on the mystique of inflationary control failed to consider the broader, nuanced interplay of monetary policies. Instead, the very rebuff of the dollar ignited the fuse beneath silver's ascendancy. Understand this. What appears as an isolated rise in silver's value is a mirror to the market's inner turmoil, revealing inconsistencies others ignore. It demonstrates the strength of fundamentals, disguised by superficial metrics. The silver market's trajectory is not merely influenced by immediate catalysts, but by the underlying stress fractures within the financial ecosystem. In this environment, vigilant investors become architects of foresight, not prisoners of fear. Harness the knowledge that precious metals are more than a hedge. They're instruments of stability in chaos. Dissect this phenomenon beyond the glitter, recognizing that each ounce reflects a broader narrative, one of resistance in a micromanaged monetary landscape. While others are numbed by panic or lulled by false security, you must rise to the occasion. Anticipate the gold-to-silver ratio shifts, respect the intricate layers of demand, and execute with precision. The tides of silver will not wait for the unprepared. In the melee of a market electrified by intangible forces, the prudent retailer stands apart. They carry the knowledge that when volatility is the norm, it's not enough to watch from the sidelines. They engage with calculated audacity, for only through action can one transcend market chaos and grasp the silver lining of opportunity. February 2026. A collision course etched in the annals of financial history. Enact the stage, the peak, the unraveling. The CME Group, a key player in the unseen machinery driving financial markets, pulled the levers that soared the stakes. Margin requirement increase. A simple phrase, a ruinous consequence. Dissect its hidden depths. It was more than a bureaucratic tweak. It was a crackdown on speculative fervor, a strategic damper on unprecedented volatility. Market stakeholders were caught off guard. Silver's dance of chaos choreographed by margin calls. Hidden undercurrents surged. Repo desks lit with frantic whispers. Calculations recalibrated in haste. Anticipated liquidity evaporated before it could stabilize. This margin squeeze transformed hypothetical balance sheets into very real nightmares. Forced liquidations became the order of the day. Silver's flash crash, a mechanical slide, brutal in its inevitability. Panic ensued. The core paradox, velocity in a once stagnant silver base market, revealed fissures in valuation models, flaws exposed by indiscriminate selling. The result? An exaggerated journey, a misstep forgiven not by sympathy, but by savage rectification. Speculative collapse mingled with margin savagery, a self-sustaining tempest, all transpired within the confines of trading pits turned gladiatorial arenas. But amidst the tumult, precious insight gleamed, a blueprint for navigating distressed assets. Remember, this epitomizes more than a glancing blow to silver valuations. It's a raw elucidation of market hypersensitivity to regulatory pivots, each margin alteration, a seismic vehicle for potential chaos or feast. investors must thread these waters, cognizant of both historical parallels and the nascent tales they craft. Navigate with poise, armed with foresight against the cacophony of reactive deployments. The CME's actions remind us, markets are not neutral territories. Each parameter shift, a new chapter of volatility. Respect the mechanisms of control, yet stay relentless in pursuit. Transcend panic. Stake claims not where markets churn most violently, but across the untouched remnants of stability and foresight. In the whiplash of February 2026, lessons must forge frameworks. Recognize that where some see glitches, others chart opportunity. Here, amidst regulatory jolts, success lies not in mere observation, but in strategic deployment. Stand vigilant. This chapter of market history demands it. The historical context of the silver market is laden with complexity, much like the metal itself. Its pricing journey is marred by episodic disruptions and structural challenges that repeatedly expose vulnerabilities. Silver's role isn't merely ornamental in the global marketplace. It's a linchpin in the quest for a sustainable future economy, a precious metal with dual identities. The narrative begins far before February 2026. Silver's path has been a tale of inverse relationships and delicate balances. With each market twitch, it has demonstrated the profound impact of macroeconomic and geopolitical tremors on its valuation. But the tumult isn't solely external. Within the market, structural issues lurk, biding time until they surface with destructive potential. One must appreciate the metal's strategic importance in the green economy to understand the undercurrents. Demand for silver doesn't ebb and flow solely on the whims of jewelry trends. It's tethered to the infrastructure of tomorrow. It is indispensable to the vehicle of change, from the electric vehicles charting new environmental paths to the photovoltaics capturing the power of the sun. Herein lies a crucial truth. Silver's demand is intrinsically non-elastic in critical sectors. As AI technologies burgeon, so does the metallic hunger. Then there's the ichor of physical supply, a shrinking guise. Inventory depletion is more than just a passing inconvenience. It's a prelude, an ominous setting for liquidity crises waiting to unfold. COMEX, a bastion of silver trading, has shown us this. Stock withdrawals chart a course through precarious waters of scarcity, accentuated by lease rate spikes and backwardation's creeping shadow. And let's not overlook China's role. A dominant force. Export restrictions cut deep into global supply veins. China's domestic demand is compounded by external dependence, shaping a precarious dance on the edge of global supply chains. This historical context is not just about recognizing precedents. It's about harnessing the foresight these precedents provide to navigate future storms. The echo of past events resonates in today's market maneuvers. Yet the narrative of silver isn't merely about looking backward, it's about strategic foresight, engaging with each shift, each scarceness, as the unfolding tale commands attention and respect, guided by threads of past echoes and future prophecies.